Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, February the 19th, and want to take just a brief minute to discuss what markets did last week as the sell-off in the overall indexes continued, as the S&P 500 was the worst performer on the week, down 1.39%. The mid-cap index is tracked by the S&P 500 was down 0.66% or 66 basis points. The small caps as measured by the S&P 600 were down 0.9% or down 90 basis points. And as you fast forward into this week, it's a very interesting dynamic that's going on as we're still continuing to see this rotation from growth to value. And last week what happened in the markets was you saw a still continued selling pressure in these software as a service company stocks and tech stocks, anything related that could potentially be displaced by AI. You're seeing those names down 30, 40, 50% drawdowns year to date. And I wanted to take a second and talk about that. Well, that is a massive drawdown. We have not seen in history before a time where a sector has had that's this large of a piece of the market cap of the overall market have such a massive drawdown while the overall market stays relatively tame. The overall index is relatively flat year to date, with the software sector down roughly 30% as an overall sector. And as we look at what's happening, let's take a step back and put this into perspective. Well, these are very large drawdowns, and it happened very quickly and very violently to the downside. You also have these stocks coming into this year trading at all-time highs, at all-time high valuations, and on runs unabated for the most part from 2022 or mainly start of 2023 through 25. They just ran and ran and ran and ran. And so if you bought these stocks at the beginning of the year, the end of last year, you're really feeling the pain. But if you've been a long-term holder of these over the last 5 to 7 years, the reason why you're seeing also the clipping here is because portfolio managers and professionals are sitting on hundreds, if not thousands, of percents of profit. So they're selling the names off here to lock in the profits that they have made to go out and buy those value names in the market. And those value names are the ones that we're seeing really outperform in the equity markets. And the question that is yet to be answered and we're monitoring very closely is, can the value trade continue? We've had plenty of fits and starts over the years. 22 was a value year, but we haven't seen where value has run for multiple years and taken the leadership away from growth. And we're going to continue to monitor closely to see if that's what's happening here. But what investors are searching for right now is they're saying, look, these are valuations that can't be moved any higher. These stocks are priced to perfection. Let's go find something cheaper that's been left behind that is doing well, returning capital in the form of stock buybacks and dividends to shareholders, that's trading at much lower valuations, and it's all being supported by a very strong U.S. economy. We have forecasts this year for growth rates of some are projecting upwards of 5% growth. You had 2 to 2.5% growth for 2025 for the overall year for the economy. It's a pretty solid year. Wages and unemployment wages are going up, unemployment is remaining very low, and in full employment is we are close to being at full employment. So these are supporting some of these value stocks and what they could do and outperform. But a lot of money's already piled into those. What if I were to tell you today that on February the 19th at 3:57 p.m. that Amazon's PE ratio is actually less than Walmart's? I think you would look at me and say, Scott, there's no way. Well, Walmart's actually trading at over 40 times forward PE ratio, or trailing 12 months PE ratio, whereas Amazon is at 28 times trailing 12 months PE ratio. And what you're seeing is the selling of these Amazons to buy some of these what are seen as more defensive, value-oriented names that do well in a strong economy or may even do well when things slow. But it is just a reversion to the mean at the moment, and you're seeing it in the raw data. So for To put it into perspective, year to date, the Russell 1000 growth is down 5% year to date, negative 5%. Complete flip side, the Russell 1000 growth, the Russell 1000 value is up 5% year to date. So growth is negative 5%, value's up 5%, 10% difference in between. And that's why you're seeing the index and the S&P at a flat to slightly down year to date number, but you've got a value index higher. Remember the market cap weightings and the impacts that those tech stocks have on the market and what they do overall. And if you're selling those, that's going to keep the pressure on the market down, while underneath you can really see some upward appreciation. And that's where active management and diversification really comes into to help you out in situations like this. So if you have questions about how to navigate these markets or this rotation, we'd love the opportunity to speak to you. You can reach us at 904-346-3460, or as always, check us out online at www.riverplacecapital.com. I hope everybody has a wonderful rest of your week. Thanks so much for watching.